All right. Good morning, everyone, once again. My name is Ernest, and I'll be moderating today's session. On behalf of the entire Black Star team, I warmly welcome you to this important discussion. We've decided to theme it Decoding the City's New Momentum, and we are asking whether the fundamentals are resilient enough or it's just a mirage we are seeing. Over the past 2 weeks, we've seen that the Ghanaian cedi has experienced a sharp appreciation against its major trading counterparts, and I mean the USD, the British pounds, and then also the euro. The rally has sort of packed some various interpretations across the financial industry. We hear some analysts attributing them to both international and domestic factors, citing the general weakening of the US dollar as a contributing factor when it comes to the external factors, whilst domestically too, it's been attributed to some robust fiscal policies and then also monetary decisions, which include gold reserve accumulation, increased FX inflows from remittances, cocoa, and even gold exports, also renewed investor confidence stemming from IMF staff level agreement for the next 300 million tranche. On the call today, we will go a step further and present to you what our results were after we ran a correlation and regression analysis to determine the relative impact of each of these drivers, each of these underlying contributing factors, leading to the appreciation of the cedi that we've seen so far. So today's conversation will break it down. We'll break all the variables down, explore their individual contributions to the currency momentum. We are going to start from Trump's second term, Trump 2.0, the announcement of the tariffs and how it's led to volatility in the US markets, and then it will cascade down to the Ghanaian cedi. So just fasten your seatbelts and enjoy today's presentation. With that said, we are going to also look beneath the surface and see if what we are experiencing currently is sustainable, because we've seen it before. We are going to compare the underlying factors of some years ago when the cedi rallied to that of this year and see what is different this time around. To help us unpack all this, we would have our very own senior analyst here at Blackstar, Mr. Enoch Sunkari, who is a member of the Research, Insights, and Analytics team. Sunkari brings a strong analytical background and in-depth knowledge of macroeconomic and currency market trends, and he's also a statistician. And so please be prepared for an insightful presentation. After the presentation, we will open the floor for questions and contributions. If there are any submissions from any participants, we are ready to also listen. Then after, we would have an anonymous poll. There's a background effect. Hello. Then after, we would have an anonymous poll, and then we conclude it. So without much ado, I would invite our presenter for today, Mr. Enoch Sunkari. Thank you.
Hi everyone. Can you hear me? And is my screen visible?
Yes, we can hear you. The screen is also visible. You can proceed.
Oh, okay. As rightly said, I'm Sunkari, and I'm with the Research and Analytics team of Blackstar, and I'll be the presenter for today's session of the market color. Today will be, in our part of the world, most often we say that the river that forgets its source will soon dry up. Yeah, today is one of those days that we need to kind of like reconsider this statement and then look at our city. Recently, we've seen an unexpected appreciation rally of our city against major trading currencies, especially the dollar, euro, and the pound, which is not even limited to that. And also, even our regional peers, if you look at the same way we are rallying against the dollar, is the same way the city is also rallying against Nigeria, almost 20% year to date. So today, most often our city is always kind of like the poster chart for depreciation jokes, but recently it has actually staged a kind of a war, a quiet but a bold comeback. Some call it a miracle, others call it manipulation, and few say it's just a calm. It is just a calm before another storm. But before we celebrate or criticize this, I think we have to take a step back and look at what is actually driving this shift. Is it smart policy choices or short-term inflows that we are seeing, or something else is behind the curtain, which we are not all looking at as the source of this recent rally. And we also look at how the bigger picture, that's a lingering US-China, US and China trade war also fit into all this. I'm going to take you through a quick update on the local space. I mean, if we have to go global to look at the global space, we should look at what is happening back home before we look at what is happening on the global front. And we'll now look at how the external influence of the happenings on the global front is actually impacting our domestic space, especially the currency. So I'll start with inflation. Inflation have started trending downwards. Then April inflation came in at 22.1, which was also driven by both food and non-food prices declining. But however, inflation actually still remains the government's target of 11.9%, and even regardless of that, the central bank actually increased their monetary policy somewhere in March to 28%. It was kind of like to re-anchor the disinflationary process that we are seeing. And this is kind of like the 8th-month low since our inflation have been moving towards the downward side. And then also look at our fiscal space, the government auction, especially the government auction. We've seen interest rate, government treasury interest rate dropping. That's a short-term borrowing cost dropping by nearly 13% this year. We entered the year in the 30s, and then as of the last auction last Friday, we were down to almost 15s, which kind of like marked like a 13% reduction since the year began. And then this is a good thing, right? Because it's kind of like easing the debt servicing pressures of government and also aligning with the government's fiscal consolidation efforts, especially if you look at that we are in an IMF program. I think this reduction is actually going to create more room for development spending, even though long-term refinancing challenges still remain. As I said earlier, however, the key interest rate, which is the monetary policy rate, is still at 28%. And this is kind of like a move to kind of re-anchor this inflationary process we are embarking on. And also look at our domestic bonds as well as our euro bonds. We look at our euro bonds, our domestic bonds are been performing better. It has been outperforming our euro bonds, and this is because of the Cedi's recent appreciation against the dollar. So if you look at it on a year-to-date basis, the domestic bonds have done almost 20%, whilst the euro bonds have done negative 2.7%. And this is just because of the appreciation of the Cedi. And if we also look at our equities market, if you look at our equities market, year to date, it has done almost 75% in dollar terms. And this is kind of like a huge and a very huge percentage gain for the local investors on our equity space. If you look at it across other regional jurisdictions, if you look at the US, if you look at the S&P has done almost 1.3% year to date, and Nigeria 2.8%, and Kenya and South Africa. But all of them also just below, very, very, very below where the Ghana Stock Exchange is at. So if I look at what happened in the domestic space, it looks like the domestic space seemed to be performing, and the macroeconomic landscape is kind of like coming together. However, I think there's tensions on the global front where we are seeing retaliating tariffs being levied on trading partners. I think Trump came into power somewhere last year in November, and things just got shaky. And then tensions are high, and then uncertainty levels are also high. And then ever since Trump came into power, I think we've seen rising levels of volatility on the market. I think if you hold stocks, you might have felt it directly. If you've held bonds too, you might have felt it directly. So when Trump came into power, we saw trade policy uncertainty rising. This what you are looking at right now is it's an index constructed by Bloomberg using the frequency of certain keywords which are related to economic policy uncertainty in mostly high circulation US papers as well as Bloomberg news articles. So if we look at when Trump came, so this index actually counts the number of articles containing these terms within a given time period, usually monthly or daily, but this is actually the daily index, the daily tracking index, and then standardize the count to create a time series that reflects the changes in uncertainty over time. Just to give you color on the rising uncertainty since Trump was elected as president of the US, it goes back to Trump 1.0. We saw that somewhere 2018 towards 2019, when Trump came in for his first time, you saw that the US and China trade war started to pick up around that time under President Donald J. Trump. It actually started when both countries started imposing escalating tariffs on each other's goods, and this led to global trade disruptions, which also heightened economic uncertainty as seen in the chart during Trump's 1.0. And Trump's returned back to office somewhere November last year. You see, when Trump left office, even though we had COVID, things were so low, uncertainty was so low. But Trump came back to power somewhere in November for his second term last year, and then we started to see policy uncertainty going over the roof. This kind of like gives you an idea of when things started getting shaky because Trump was now the president of the United States. But if we look at just a few weeks ago, we saw that he has kind of like given a 90-day pause to the implementation of these tariffs. And then this is kind of like reducing we see that its uncertainty is gradually coming down to the lower levels. And so if we look at across the markets, what has been the impact ever since Trump came into power? We saw that we saw in the earlier chart, we saw that trade uncertainty went over the roof, and markets reacted. I mean, as always, market always react to some of these sentiments on the market. We saw volatility indicators as if we look at the VIX, which tracks volatility in equities market. We also look at the MOVE index, which tracks volatility in the fixed income market, as well as the JP Morgan volatility index, which track FX volatility on the market. We saw that when Trump came and then the earlier tariffs were announced somewhere February, we saw that volatility started to pick up, started to rise, and then it started slowing down somewhere March. And then we saw on Liberation Day when the actual numbers were red, and then things went over the roof. We've been talking about tariffs all year, but it's kind of like the market reaction to it was kind of like unexpected. This is because even though market was aware of the incoming tariffs, they just didn't expect they just didn't expect the extent to which they were going to be. The numbers came in very high, and people started betting on recession concerns. People started saying the global economy was going to slow down, and which was going to force us into a recession. But ever since, as the agreements and negotiations evolve, we've seen that it's kind of like not really likely we are going to have a recession in 2025. Maybe we may have to start looking towards 2026. So if we look at the recession, there's a recession index. At least if we look at the data we have now, it doesn't really show that recession is kind of like imminent in 2025, even with a pause on tariffs implementation, and also looking at the fact that there is renewed renegotiations among the countries. So if you look at the top chart, this is a recession index, which is a real-time indicator developed by an economist, Claudia Sam, which is used to flag the start of a recession in the US quickly and reliably. So she used data from the unemployment rate and the unemployment data to build this index. We saw that the first time this index went up over the past 7 years, it was kind of like when we had COVID, and COVID was one of the time that we had recession. But when we look at it this year, things didn't really get that high. Even though people were betting, the market was pricing in and betting on recession this year, we didn't see the index rising this high. And then even though it's getting closer to the key level, which is the 0.5 level, but it doesn't just say, okay, if it gets to 0.5 level, there's a recession. It just gives an alert that we may be in the early stage or in the early stages of a recession. But we are not seeing that. Even looking at the GDP number for the first quarter of US, it came in higher. I don't think this is so. This kind of like buttress the fact that recession concerns for 2025 may actually be fading. But with all this, looking at trade uncertainty rising with volatility in the market spiking, and also looking at recession concerns now fading. But it's kind of like the most noticeable impact of this trade war is kind of like the dollar. The dollar has been the dollar seems to be weakening, and if we look at just 1 year ago, when Trump in 2024, if we look at 1 year ago, the dollar index, which tracks the performance of the dollar, starting from 2020, we've seen that it's kind of like been on a declining trend. Even it got accelerated when the earlier tariffs were announced, and if even inch lower when the actual tariffs were levied. And it seems to be recovering, but every now and then it takes the downward path. But just not even without this trade uncertainty, policy uncertainty, tariffs, and all of that. Without that, but the dollar kind of was entering into an earlier stage of a long-term structure observation that have always been made. I would think that policy analysts and other market watchers are saying that the dollar, they don't think the dollar is actually facing an imminent collapse, but it kind of like maybe entering into the earlier stages of a structural sell-off. Familiar with a long cycle story that's starting to kind of like play out again. We've seen this before, somewhere between 1980 to, it's kind of like every cycle, like almost 7 to 10 years time, the dollar kind of like enter into a new cycle. If we look at somewhere in 1980, if we look at somewhere 1980 to 1985, we saw the dollar rally up because of high US interest rates as well as tight monetary policy, which led to the inflows of capital into the US. And if we also look at just after that, where between 1985 again and 1990, we saw the dollar declining again, which was because of a coordinated effort by some big countries to kind of like devalue the US dollar. I think it's generally called the Plaza Accord, which played out during those times. And we also saw that between 1995 to 2000, the dollar began to strengthen again because of the tech boom. That was the time we had a tech boom, that's a dot-com boom, and then the strong growth in the US. So capital flew into the US because of the tech boom. I mean, a lot of capital was going into to kind of capitalize on the tech boom that was happening during those times. And also look at between 2000 and 2008, we also saw the dollar weakening again. It's kind of just moving in circle. The dollar started to weaken again because there was a lot of massive rate cuts. That was a time US was facing huge and large fiscal deficits, and also that was also the time we also saw the rising of the euro. Also, emerging markets also started to experience fast growth. Fast growth. And if we also look at just after that, between 2010 and 2020, we saw the dollar rally again. There was also because of the Fed tightening that was happening within those periods, and the US tech dominance became a widespread thing, and then everyone was moving towards the US to take advantage of that. And then US suddenly became the safe haven for capital. And also look at 2020 and 2023 when we had COVID, and then everybody was moving towards the dollar. And just this now, we've kind of like feeling kind of another peak for the dollar, and then a bearish or a declining trend may be forming from this stage from 2024 over the next few years. And this is kind of like something that is forming out and is more evident in the market. Right now, we've seen the bricks coming in. We've seen the BRICS coming into play here. We see the BRICS are now pushing for local currency trade and alternative settlement systems. And we're also seeing central banks also diversifying their reserves. Now we're not seeing more gold in central banks' reserves and less of the dollar. And we're also seeing US fiscal deficits are also growing, and there's political uncertainty that may also reduce foreign appetite for the US treasuries. We're also seeing emerging markets with credible monetary regimes like India and Brazil, which is also attracting capital. I'm also seeing that even with all of this, the US dollar is still, if you look at the reserve percentage of the US dollar, it used to be above 60, and now we are around 58%. And if we look at, it's kind of like a coordinated effort by all these measures, kind of like trying to move away from the dollar. And then this is kind of like it's going to accelerate the bearish trend of the dollar over the next few years. So maybe the dollar is actually entering into is entering into an early stages of a sell-off or a bearish trend. And this has an impact on our market, right? Because when the dollar is kind of weakening, our currency, especially emerging markets and other frontier markets, currency seems to strengthen because capital may be leaving stronger dollar regions to these countries. So Ghana is not left out. Amidst all of this, our Cedi has also been rallying against the dollar. And some are actually saying that, and this is kind of like something that is unprecedented. It's not something that has been happening. And then some are also saying that maybe it could be because of the global tensions that is happening, which is causing the dollar to weaken. That is also making our Cedi to strengthen on the back of the weakening dollar. So if you look at our currency, what has actually been the trend of our currency? If you look at the time ever since we did the redenomination, our cedi has always been trending downward. I think we redenominated the cedi somewhere in 2007. Since then, the cedi have lost almost 92% of its value to the dollar, and as well as other currencies, other major trading currencies, the euro and the pound. It has always been weak, and this is kind of like I don't think this is kind of an evidence of our structural deficits that we face as a country. And if these structural deficits are not really dealt with, we might really not recover. But what it means is that if you had one cedi somewhere in 2007, right now you would have been left. If one cedi could get you $1 in 2007, it means right now maybe 0 cents of the dollar can actually get back the one cedi. You will not really get as high as you used to get. But this is just assuming that you held cash all this while. But if you had invested your money, say T-bill and roll over to this day, you would have been kind of like in a better position than those who actually held cash. And this resonates with the reasons why you should be looking for ways to invest your money in asset and interest earning assets. We have seen how the dollar has been behaving, but in 2025, we kind of see a different trend that is kind of emerging. How is this trend like in 2025? In 2025, we've seen the cedi, as usual, was trending downwards. It moved, it trended downwards to somewhere in the last weeks of April. We started to see a sharp shooting in the upward side. The cedi started to rally against our major trading partners, our major trading currencies, which is the dollar and the euro and the pound. So the cedi appreciated widely against these trade counterparts, and then it's up almost 20% against the dollar and 12% and 10% against the pound and the euro respectively. If we look at this is kind of like if we look at from the beginning of the year, the dollar was weakening, and then our cedi was weakening as well. But we just got to some point last week, last few weeks of April, then we started to see a shooting up in the upwards direction. But some people are also arguing that it's kind of like it's kind of like the cedi is doing something unprecedented, and then it is the only currency kind of like benefiting. Some to also say that it's the only currency that is also benefiting from the global tensions we're experiencing. But I don't think that is the case. When you look at across markets, if you look at our regional peers in Africa, some other currencies are performing well against the dollar. Maybe on the back of the weakening of the dollar, which we are going to take a deeper look at in our next slides. If we come to Africa, I realize that the Ghanaian cedi, South African rand, the Zambian kwacha, and then the Mauritian rupee, as well as the Egyptian pound, are all rallying against the dollar. And if we also look at, but it's not all countries that are in Africa that are actually benefiting maybe from the weakening of the dollar. We've seen some other currencies that are performing badly. If we look at the Tanzanian shilling, the Liberian dollar, as well as the Nigerian dollar, Botswana pula, and also the Rwandan franc, their currencies are actually not performing well against the dollar if we look at their year-to-date performance. So some are also saying that, has the cedi always performed better in our second quarters? Is it because we are second quarter and we have a second quarter trend of good performance? If we look at the data does not actually show that. Even though this is the snapshot of the past 5 years, it is not really, if we go as far back, it's not really the case that we've been seeing a seasonal trend. We've always had a lot of depreciating quarters than we have for appreciating quarters. For first quarter, it could be understandable because we have a lot of foreign capital in our market, which most of them close their books for the year and do repatriations in the first quarter. For the first quarter, it's understandable. There's always kind of like so much pressure on the dollar. But for the second quarter, there's no clear trend of the Cedi always gain. The last time we had the Cedi gain against the dollar in the second quarter was somewhere in 2023, but which was not that significant, just 1.54%. But this time around, we've seen the Cedi rally against the dollar in the second quarter, almost 26.8%. If we look at December, it's also kind of like on an average over the past 5 years, we've always had the Cedi kind of stable and in some cases appreciate a bit against the dollar in the last quarters. But this is also as a result of the 30 December plans that normally happen, festivities that normally happen in Ghana. We see a lot of foreigners coming into our market with FX to have their time here in the last quarter. So if we look at some also arguing that maybe because we are in an IMF frugal, that is the reason why the Cedi is actually also performing well. So looking at all these factors from the weakening dollar argument to the seasonal argument, if we also look at the IMF argument, it's actually kind of true when our big brother, the IMF, is in the room with us. Our Cedi seems to behave well. It seems to appreciate against the dollar, and then maybe it seems to depreciate lesser than it normally depreciate when the IMF is out of the room. If we look at the annualized rates of depreciation over the periods we've been in IMF. If we look at the IMF, when we're at the IMF, that is the blue bars. We've seen the Cedi depreciating. The last time, the worst we had was 9%. But when IMF is out of the room, we go as far back as 28%. So maybe some people are saying maybe it's good that IMF is always in the room with us. Let's also look at all of this. It's kind of like there's always pressure on the Cedi almost all the time, whether with IMF, weakening dollar, whether we have remittances, we have people coming in December to spend so much dollars here, to convert their dollars to spend so much Cedi here. If we look at all of those factors, but it still seems like we've always had this kind of pressure on our Cedi. But let's face it, the exchange rate is fundamentally a reflective of supply and demand pressures, right? So Ghana is kind of like limited. Ghana, we have limited capacity to generate sufficient forex exchange. And this only amplifies the impact of the structural deficits and then the economic vulnerabilities we have. They've always been persistent pressures on our Cedi. We have scarce FX, and then this has always been something that is weakening our Cedi and then making it depreciate so much against our major trading partners. But where are these pressures normally coming from? If we look at our country as of now, oil, petroleum products as well as being one of the biggest things that is kind of putting so much pressure on our Cedi. Ghana's dependence on petroleum imports makes foreign exchange access very critical for the bulk oil distributors, that's the BDCs. And the disruption in their ability to secure FX can actually cause a ripple effect across the economy. And this normally puts so much pressure on the Cedi. So most of FX demand, some of our large FX demand normally go to the BDCs because of the services they provide. All the time we need to get them the money to kind of get us oil because this powers almost every part of the country. And if we look at the amount they've been demanding over over the few past months, you've seen that we've seen the highest somewhere in April. All the time, on average, almost every week, these BDCs demand almost $85 million every single week. And then these are the people that provide oil for us. They are the people that bring in oil, and oil is one of the critical commodities that we can't actually just play with. And then this demand have to always be met. And this has always put persistent pressures on our city. The only issue is look at just between 16th and 30th of April, when we saw the highest level of demand, even on the back of when we look at the oil prices, which is the gold color. We saw the oil prices were dropping, and then the demand for FX was high. But the Bank of Ghana is not even able to kind of like supply this level of demand, right? 85 million. The Bank of Ghana is only able to supply 20 million weekly. Over the past few months, we've seen only 20 million the BOG have always had to give back to give to the market, and this kind of show you the level of pressure that these BDCs put on the city because of their dollar demand. Also look at our imports. As said earlier, we import our oil. But if we look at we import our oil, and this kind of make the BDCs to put so much demand on so much pressure on our city. And if we look at the imports alone together, if we look at generally, we import averaging almost 14 billion every single year. But that is not really the case. If we look at from 2017 to 2024, we've always run a positive trade balance. This means that we've always we import lesser than we export, meaning, and then we have excess FX coming in than FX going out for imports. But this is also one of the pressure point because of our imports. And if we look at what do we actually import, as I said earlier on, most of our FX demand is for BDCs, and then these BDCs kind of like import petroleum products. And so if we look at our import bill, the top 10 imports, it has always been petroleum products. We import about 3.4 billion worth of petroleum products every single year. And some are also arguing that maybe one of the major pressure points that we have is because of debt, because we borrow a lot, and because we borrow, and most of our debt is normally in foreign currency, the dollar. And then so when you borrow, you have to pay back, right? And once we get towards the time of payment, a lot of pressure is put on the cedi, which makes you to depreciate to unbeliever levels. So if we look at when we started, we issued Eurobonds between 2013 and 2019. When we issued Eurobonds, we realized that that's when we borrowed money. When we borrowed FX, when we borrowed in foreign currency, we saw that our cedi was relatively stable. The inflows from the Eurobonds was kind of putting less, was giving us enough FX, which made the cedi to kind of remain stable. But as soon as we reach repayment periods, we see that the cedi start to depreciate and then to lose its value. If we look at 2022, when we had that, let me start from 2018. Somewhere in 2018, when we had to pay, you realize that the cedi was coming down, but immediately we issued another debt to pay back, to refinance the old debt. We saw the cedi actually going up. And then when we got to 2022, September, of which we paid, and then the next Eurobonds maturities, which were just the next year, 2022. This was the time the cedi started to, if you remember the November rally, we saw the cedi going depreciating so much somewhere in November, and after that we saw a sharp recovery. And this was because when we were approaching the cedi and we couldn't pay, we see when we are approaching the payment and we couldn't pay, we didn't actually pay, right? So there was no demand for FX anymore. And then we saw our CD beginning to recover. So our Euro bonds, our debt is kind of like another pressure point that puts so much stress on the CD. So if you look at if you look at the Euro bonds maturity profile, you realize that the next pressure point we may be expecting is somewhere 2026, about 300 million, which is not really a large amount. And I don't think it's going to have any significant pressure on the CD. But over the time, we've tried several strategies. Even though we know that we import a lot, even though we know that Euro bonds, when we borrow in foreign currency, it puts so much pressure on our CD when we're about to repay. Even though we give so much to the BDCs, the bulk oil distributors demand so much of dollar, which puts so much pressure on the CD. We've always tried to mitigate these kind of shortfalls and then lessen these pressures. Over the years, we've always relied on our reserves. We've always relied on our reserves for FX supply, but somewhere in 2022, we kind of lost it. We saw our reserves depleting to the lowest level. If you go back we depleted to the levels we were somewhere in 2017, meaning in 2022 and 2023, we kind of like eroded about 5 to 7 years of hard work of building our reserves to somewhere 11 billion in 2021. But here, a lot of things happened, right? During the same 2022, this was the time, as I showed in the lectures, was the time we approaching our Eurobond payments, and this was also the time we had the gold for oil program, which was launched, which we tried to kind of let me give you an overview. Our reserves are it's a diversified portfolio, right? We have gold in there, we have foreign asset dominated in there. We also have US dominated assets in there. And when we started the Go for Oil program, what it meant was that we're going to exchange our gold directly for oil. And this was kind of one of the measures, the strategies that was used to kind of lessen the pressure on the CD. And then I'm going to take a deeper look at that. But our reserves have fully served as our go-to place for our FX flows. But over here, again, as we will see, you will see in the next chart, the reason why we also had to kind of deplete our reserves at this level to from almost 11 billion to 5 billion somewhere in 2022 to 2023 was because we had an exit of our foreign investors from the domestic market. I mean, not a total exit, a partial exit. So if we realize that because when the foreign investors come into our country, what they did was that they have dollars, right? So they have foreign currency. They needed to change into cities to be able to do their investment transactions. And when they did that, they kind of swapped their CDs their dollars for the CDs. And these dollars were part of our reserves. And just as we're getting closer to 2022, remember that was when we had to our first when we had to pay Eurobond maturities. And these investors had done their assessment, they've done their analysis on the macroeconomic landscape of Ghana, and they realized that maybe it was time for we're approaching dangerous times, especially with because that was the same time we saw debt levels rising, and then we had COVID around those period too, and then things were not really looking good. The outlook on Ghana was not really looking good, so they needed to exit. If we look at from 2021, foreign investors holdings on our bond market was about 28.8 billion, And then this was kind of, so literally what happened is that they have to change their US dollars for this amount of money to invest. But because the macroeconomic landscape was not looking well, and then even we were also on a run up to our Eurobond maturities, and they needed to exit. You see, in 2022, we saw the foreign investor participation on our local market drop to almost 13.8 billion. That's almost about more than 10 billion wiped, 10 billion Ghana cedis wiped out of the market. And this kind of this amount of this volume of money was supposed to actually be converted back to USD to live. I mean, they came with USD, they changed to CDs. We kept in our reserves. They had to leave. They had to convert back their CDs to their dollars and exit. And when they exited, if you realize, that's when we started having. We saw a huge depletion of our reserves, which kept kept so much pressure on the city that year in 2022 and 2023. And so if we look at our reserves trend and our city depreciation, we realize that when we have reserves, this is the 12 months rolling depreciation and appreciation, as well as our gross reserves changes. If we look at starting from 2010, somewhere when we discovered, when we started oil production from the Jubilee Field, we saw our reserves going up as high as increasing as high as 100% year on year. And then we saw our city also appreciating in those periods. And when our reserves started to reduce, we saw the city also depreciating again. And somewhere between 2012 and 2018, where we saw our reserves consolidating, increasing and decreasing at almost the same pace, we saw our CD actually sustain and stable for a while for all those periods, because at that time we're issuing Euro bonds, right? So we're having a lot of inflows of FX coming in. So there was enough supply to meet the demand on the market. And somewhere in 2021, as I showed earlier, when we saw our reserves depleting, and then also in the run up to Eurobonds maturities, we saw the CD actually depreciating, but we had to post payment on those maturities. And this was also the year we defaulted. Then we didn't need to pay. We saw the CD rallying back. And this is also at the same period we started to build our reserves again. And we also started our domestic gold purchase program just a few years before that. So we'll look at the gold for oil. So the gold, this is a bit, a little bit complicated, but I will try to see how best I can simplify the whole model. So this was because of the pressure on our CD, and the pressure was also largely coming from our large demand for petroleum products. That's mostly oil. There was kind of a strategy, a policy that was formed to kind of solve that problem. I mean, if we don't need to buy our oil with dollars in cash, we may try to use our gold. And that was the whole idea of that. This was kind of to bypass the process of demanding for dollars cash to purchase this oil, and which was supposed to reduce and lessen the pressure on the CD. Because this was also going to reduce, subsequently reduce the demand for dollars for these transactions. So the gold for oil model was actually introduced by the government of Ghana in 2022 as a strategic initiative to actually reduce pressure on the country's foreign exchange reserves by using locally sourced gold to procure these petroleum products. So at the core of this arrangement was actually a barter system in which the Bank of Ghana, that's BOG, was purchasing this gold from the domestic market. That it was basically from the now Gold Board, but the then Precious Minerals Marketing Company and other licensed gold suppliers using Ghana cedis. So cedis was actually used to purchase the gold from PMMC, and then this gold is then used as a means of payment for the oil. So effectively, what was happening, bypassing the need for the use of our scarce US dollars. So once the gold is acquired, the Bank of Ghana transfer this gold to an international commodity bank or an intermediary, basically a broker, which now facilitate this barter exchange for the oil. So without needing to kind of use the scarce dollars we have in the country to directly purchase this oil. The oil is then subsequently delivered to Ghana by the suppliers. These suppliers supply the petroleum products monthly to to bulk oil storage and the transportation company, and then which now serves as BOSS now serves as a distribution agent in the domestic market. So BOSS then sells these petroleum products to the local consumers, the BDCs, in Ghana cities. So in the whole exchange, the idea was just to kind of like eliminate the direct use of the limited dollars we have to purchase this oil. And then this was also in an attempt to lessen the pressure on the cedi because there was going to be less demand for dollar. And this was going to now release the stress on our cedi. So these payments from these customers were now also made through LCs, letters of credit, or direct cash deposits into a designated collecting bank, the Consolidated Bank. And Consolidated Bank now gives Bank of Ghana access to draw these proceeds, totally eliminating the need for US dollars or foreign currency in these transactions. So the Bank of Ghana monitors these accounts closely and sweeps the process to recover the funds that were used to originally purchase the gold. And this is how the gold for oil model looks like. But don't forget the barter system. A barter system was actually used purposely just to kind of reduce the pressure that was on the dollar. So we had the pressure points. We realized that the pressure points were coming from our imports, mostly our petroleum products, and also we started to solve it with our reserves, which didn't really, which we depleted somewhere in 2022, and we came in with the goal for oil to kind of reduce the pressure on the cedi and lessen the demand for the dollar, whilst we find ways to build back our reserves. And if we look at the gold for oil, during the gold for oil time, the main idea of the gold for oil was to stabilize the cedi and also to stabilize the prices of petrol on the Ghanaian market. So if we look at the time the gold for oil was launched, this was also the same time we were having maturities, European maturities, debt repayment, which we didn't pay, which coupled with the gold for oil, the less demand during that period will actually push the cedi. So if we're looking at whether the gold for oil program actually worked, it was not only the only strategy that was used in 2022. It was in couple with other things that was happening. We didn't have to pay our Eurobonds as well, and then all this made the cedi to rebound. And we said, as I showed earlier, after 2022, when we depleted our reserves and we tried to go for oil, and whilst we were now monitoring weather ways to strategize and effectively rebuild our reserves back, the government of Ghana launched a domestic gold buying program in 2022. Just to put this just to put enough color on this. Over the past 15 years before 2021, our gold reserves was actually at 8.77 tons. That's basically 8.8 tons. And the Bank of Ghana launched a domestic gold buying program to improve their reserves. But unfortunately, we don't actually have data for between 2021 when the program was launched and last 2 years, May, when we started seeing where the data started to be made public. So if we look at the Bank of Ghana gold buying program, and then also the conscious effort to rebuild our reserves. I mean, as I said earlier, we've always relied on our reserves, right? Which got depleted. We tried gold for oil, and now we started resorting to an aggressive gold builder program. And then over just between May 2023 and 2025, we bought our gold reserves almost more than 200%, from 8.8 tons to almost 31.4 tons. So if we look at the net additions on a monthly basis, between June, we saw that we were seeing a lot of additions that was happening because the program was really aggressive those periods, which we saw a slowdown somewhere in February. Sorry, so we saw a slowdown somewhere in February 2024, which was we started to see another aggressive build up on our gold reserves. Just all in our effort to build back our resource. As I said earlier, our go-to place for our FX management. But if we look at this year, there's not much that has been happening on that front. We've not seen enough additions just the first 4 months of 2025, from January, February, March, and April. We saw that the additions to the reserve was not really a lot. But this is because we had to export more and take advantage of the gold prices. As I said earlier, the global tensions had an impact on the market, which led to gold prices shooting to as high as 3,300 per ounce, and also so cocoa prices also rising. So we're locking in on gold prices, I think, which reduced the net additions in these months. And recently, there's a newest addition that is kind of not an addition, but there's a newest addition to our backup strategies in our efforts to rebuild back our reserves, to create a more sustainable path for managing our forex volatility, which is the gold bond. It's not entirely new, as I said. It's not entirely new. It's essentially kind of a rebrand and a strengthened version of the OPMMC. But at this time, it comes with a much broader. It comes with much broader powers, which are all in the direction of making sure that we rebuild our reserves to very significant levels, as we saw in the earlier charts. Of how our reserves level have been. So even if you go back to our reserves level, if we look at between 2023 and 2024, we've seen the conscious effort that is happening, and then we are kind of like aggressively building back to where we left, where we lost it in 2022. We are for the last data from BOG. As February, I think our reserves were around 9.4 billion. But if we look at the recent additions, considering our cashing on gold, and also our gold, that's our gold export, and our cashing on the gold at the high prices of gold. If we do the extrapolation, I think sometime as of May, we should be around. The official data is not out here, but we should be around. If we do just looking at the numbers and you do an extrapolation, we should be around in excess of 10 billion. So let's go back to the newest addition that is kind of being formed to kind of strengthen and also collaborate to push the reserve building agenda, which is the gold board. The gold board has been set up to kind of act as the sole authority. I mean, I'm going to speak on just based on the information we have, what they are in for. So the gold board was set up to kind of act as the sole authority for building, selling, assaying, valuing, and also exporting gold. Basically, they were just there in charge of buying the gold, testing it, testing for all the quantity and the quality of the gold, and also selling, also valuing as and exporting as well, to lock in on prices and also to bring in FX into our reserves to help in our FX volatility management strategies. Now, but why the gold board is necessary from an economic standpoint of view? So if we look at our reserves, have depleted, and we are consciously trying to build it out. I think first the gold board is, if you look at gold, is Ghana's top export, right? So by kind of like routing more of these gold exports through official channels, gold board would kind of help to ensure that a greater share of this foreign exchange earnings actually ends up with the central bank, that's in our reserves, instead of being lost kind of through the normal smuggling and informal sales we've been experiencing for decades now. Second, I also see that maybe the gold board coming in this time around, we are going to see more dollars flowing into the central bank. As I said earlier, the Bank of Ghana will now be able to build stronger reserves, FX reserves, and this will give more firepower to the step in to just give more firepower to step in and support the cedi, which is going to help reduce the exchange rate volatility we've been seeing, and our cedi may strengthen because it's basically demand and supply. If we are able to bring in more FX into the market to meet the demand, I think our cedi will be able to be sustained at those levels. But that is not only the only factor, but if you also look at the gold board also seek to have a certain kind of monopoly, right? This monopoly is kind of intended to help us to curb illegal mining and smuggling as well. Because when more gold is traced, so because if when more gold is traced to a formal system, it becomes easier to actually regulate and track, especially also track and also implement our tax laws on these uh, domestic transactions that are happening, which is also going to help us also expand our tax base and also improve the overall economic oversight. If we also look at finally, I think by also increasing the volume of gold going through official channels, that's if only the gold board is able to implement, also able to really do what they are requiring to do. We are going to have large volume of gold also going to official channels, and then government revenue from taxes and also royalties also go up because we can now account for the full gold that is coming out of the ground, that is coming out of Ghana, and then also giving us more fiscal breathing room without needing to raise taxes and other and also take on new debt. So for the gold board coming in, I think this is also a strategy to build back our reserves so that we can lessen the pressures we've seen in our pressure points. So if we look at our gold export trend for over the past 2 years, from January 2023, then we saw at the time when we saw gold exports being low, and somewhere October we saw a spike, and then we saw that we were exporting more, and we started to export more. But this year, something unprecedented happened. As I said earlier, global tensions actually was a favorable thing that happened to gold. We saw gold shooting to the highest levels, to the 3,300 mark, which also in those periods, we saw gold exports hitting its highest height. We exported almost 2.7 billion Ghana cedis worth of gold. Just to put this in perspective, I think the deputy governor of Ghana, of the Bank of Ghana, actually said that they are looking to get to a point where we get to see an export of almost 1 billion every single month from our gold. But then this is also dependent on our gold price, where gold prices are heading, as well as the production volume of our gold. And so if you look at it, just to put it in perspective, we went to IMF for we went to IMF for $3 billion, and then just within 4 months, we are able to do 2.7 billion from gold. And then the governor is saying they are looking to get to a point where you are able to do 1 billion every single month. So just to put it in perspective, if we take 1 billion every single month and you multiply by 12 months, you'll be getting to 12 billion coming in from gold alone. And this is going to be very significant it's going to be very significant enough to solve to give enough supply to the demand we normally see from the domestic market for FX. This is going to actually help in an aggressive build-up of our reserves, our FX reserves. Um, Now, to looking at all of this, some people argue that maybe because we exported more gold is because look at the macro, the domestic macro landscape is actually coming together. We are seeing inflation coming down. We saw short-term borrowing costs also coming down. We've seen uh, uh, Bank of Ghana hiking its monetary policy rate to 28%, which surprised the market because the market was expecting a cut, and we saw the highest level of liquidity mop up happening in just last month, April. We saw almost government of Ghana, the Bank of Ghana mopping up almost 33 billion Ghana cedis from the market. I mean, this is kind of reducing liquidity in the market, and then all this come together to kind of like strengthen the city. So people are saying that maybe because the yield curve has corrected, the macroeconomic landscape is becoming favorable. We saw S&P also upgrading our ratings from selective default to the C level. We saw inflation coming down to 21.2%. And we also saw the weakening of the dollar. And people are also attributing that maybe the recent surge, despite these pressure points, despite the effort to build back our reserves, despite the fact that we are now incorporating a new regime of for our gold control systems in Ghana, that's the gold board, all of these coming together have had an impact, and that is the reason why maybe the city is doing well. So we went a little bit deeper to look at it from a statistical point of view. We dig deeper into the numbers, and to look at what the variables are saying about our currency. Just to give an overview of the numbers, these are the actual USD GHS. That's the actual 10 cedis, 14, 12 cedis for a dollar that was used in this analysis. And all of these are actually also in their actual face values we see. So if we look at the argument, if we look at the past 5 years, you realize the gold prices and cocoa prices, as well as trade balance, as well as the actual liquidity in the system, our money supply, and also our cost of borrowing on the treasury market, and also the dollar index, where it really helping our city. It was rather pushing it up. If you look at the correlation coefficient here has more than almost all of them are more than 50%, which means that they had an impact, a very strong impact on our currency, which means that our currency was actually depreciating. But if we start to move towards the last 3 years, we saw those correlation links seems to be reducing. And then if we just look at the past 1 year, then we see that things started picking up, and we are seeing that gold prices and cocoa prices, trade balance, as well as monetary supply, as well as the cost of borrowing, as well as the dollar index, which means that if the dollar index is strengthening, and then all these other variables are increasing, are going high. For the past 5 years, it was actually hurting our city. It wasn't really helping, even though we are a gold exporter, we are a cocoa exporter. We've been running a positive trade balance, and then we've had so much liquidity in the system. All those were actually weakening the city. And then if we come down to the past 3 years, we saw that link start to reduce, and we will come to the past 1 year where we start to see actual, we've seen that things have started picking up. So for the data for the past 1 year, we've seen the correlation flip from a strong positive, which means depreciation for our city, to a negative, which now means that cocoa prices over the last 1 year, when they go up, we are able to lock in on the prices, which has a direct impact, what actually causes our CD to appreciate against the dollar. We also see that gold reserves over the past gold prices over the past 1 year. We actually did a separate correlation analysis. So we realized that our gold reserves was having a very strong correlation with our gross reserves. Which indirectly mean that there can be a switch. We can decide to use the gold reserves as well as the gold prices. So what we've seen is that for the past 1 year, is when all these factors can be argued to be helping our CD to appreciate against the dollar. But we went further to look at the impact to which this actually had on our currency over the various years, past 5 years and the past 3 years, as well as the past 1 year. So when you run a regression, you realize that for the past 5 years, we've seen a very strong significance coming from our reserves, our cocoa, and also our money supply, as well as our T-bill, our cost of borrowing on the domestic market. When you move down to 3 year, the past 3 years, we saw that it started to reduce, the impact started to reduce. And then when we look at the past 1 year, the link seems to have broken and it became so weak. So the gross reserves, the gross international reserves was actually the most consistent and the most significant driver of the exchange rate across all periods. If you look at it, you could look at the data available. So for the 5-year, 3-year models show that the 5-year and the 3-year models show that the gross international reserves, as I said earlier, we have always depended on our reserves for our FX liquidity management. And the data is showing that for the past 5 years and the past 3 years, the gross reserves has been what is happening for anything at all to be, if our CD was to kind of strengthen against the dollar for anything at all, it would have been our reserves as well as the actual liquidity that was also mopping up, BOG was also mopping up from the system, and also look at our imports, also explaining most of the accurate currency movement. This also reinforces that our gross international reserves is not only a buffer but also a powerful anchor for the currency stability. So beyond the reserve, we've seen that the money supply as well as the BOG open market operations have also shaped the FX movement. We've seen that the N2 price also reflects the domestic liquidity condition, because when liquidity is loose, we see the CD tends to weaken, but BOG auctions, even though BOG auctions were not even that significant in the long term, we've seen that it has become more visible too in the short term, and it is helping it is helping to manage the volatility, and also it's also signaling monetary discipline in the system. So together with all of these levers, this kind of like for the core of Ghana's short to medium-term FX defense strategy. So if we look at all of this together, I mean, when BOG mop up a lot of liquidity from the system, it kind of like strengthened the CD locally, even at the time that we are seeing lower demand of the dollar because of the halt on the domestic market participant on our gold market. And we've also seen the rising export, which is also ensuring that our reserves are up for FX supply. All this coming together has just been the factors that are, if for anything within the last 1 year, has been what is driving our currency. Maybe it's cumulative effects, a net effect, it's a lagging effect that is happening. These things happen in the past, but it's just beginning to pick up. And we think that maybe if we continue to actually put so much into our reserves and also enhance our domestic monetary liquidity strategy, we may be able to kind of strengthen the city locally as well as bring in enough FX to support the city. But in all of this, what does a strong city actually means? I think we see there are two sides of the story, right? Those who are in the diaspora are actually really not happy because the city is appreciating against the dollar. And those on the domestic market is actually so excited that the city is actually appreciating the dollar. Looking at all the pressure points and all of that is happening, and all the strategies we've tried, and if with this recent surge, this recent appreciation is sustained in a long time, in the long term, what does it actually mean for Ghana? What it means is that we are actually, the local currency is going to be strengthening, which basically means that it's going to require fewer cities to actually purchase a dollar or do a dollar transaction. And so meaning this appreciation is going to bring benefits to the economy. I think first, most importantly, is going to make imports cheaper. I mean, so goods such as fuel, which is petroleum products, which tops our import, which kind of puts so much pressure on the city, it's not going to be so anymore. We may not be demanding so much dollars just to import fewer goods. We may just, our city has become stronger and require fewer cities to do those transactions. A stronger city is also going to reduce the local currency cost of servicing our debt, especially if we look at especially our external debt. If we look at these debts, which are mostly dollar denominated, as I showed earlier, which is a pressure point, which debt, dollar denominated debt are kind of like some of the major pressure points that have been putting so much pressure on the city. So if we are able to kind of sustain this level of appreciation, what we are going to see is that our debt levels are going to reduce, and we will not really have to stress so much to refinance or pay off these debts. However, it's not. We're also going to look at. We're going to see investor confidence also improving on the market. I think that's also one of the points, because this macro economic landscape that is aligning in a way kind of give a certain, the markets are always sentiment driven, right? People react to it. So we expect investors to kind of now have confidence in the country. And then this will also, the resultant factor is also going to be, we may see foreign investors coming back in again. As we saw earlier, when they left, what happened to our reserves? It got depleted. We may see them coming in maybe again, and this will mean that we are going to have enough inflows into the country FX reserves, and then which is going to kind of strengthen the city. We're also going to see a lower cost of living, which is also going to help Ghanaians, because rather you now require fewer cities to kind of do transactions you have required to a larger amount of cities to do. And so also, as I said earlier, investor confidence also leading to reserves boosting, and this is even one of the things that I would like to actually, because the government stated in their budget that they're looking forward to come back to the domestic market again, the bond market again, to issue bonds. So, which means that maybe if they count these foreign investors, because the macroeconomic landscape is has picked in a way, we may see enough FX inflows into our country. But just not to look at only the positive sides, I think we should have to look at what it also means for us. I mean, you can eat your cake and have it. If it is strengthening, if the cities strengthening against the dollar is sustained for a longer period of time, it's also going to hurt Ghana in a way. We are going to see competitiveness in our export market because it's going to make goods more expensive to the international market, which could reduce the demand for especially our larger exports, cocoa, gold, and other major exports. And it also means that remittances also sent from abroad, usually in dollars, and convert into a fewer cities, and potentially reducing household income for those who rely on their relatives abroad, on remittances abroad. If you also look at our tourism sector, a stronger city could also make Ghana a more expensive destination for foreign visitors, as we've seen that in the last quarters of the past few years, we've seen a lot of strengthening of the cedi against the dollar because of 30 December and Ghana being a tourist attraction place for other people to come in. We may not see that anymore because maybe we may see that they will see that our country is becoming more expensive, but which is also net a good thing for us again. But so overall, if we look at the cedi appreciation, it's going to help control inflation. It's going to help us to reduce our debt burdens, and it will also create challenges for our exports performance as well as our foreign income flows. But this impacts generally it depends largely on the reasons behind the appreciation of the cedi, whether it's improved economic fundamentals or temporal capital inflows. If the macro is the macroeconomic landscape that is aligning, that is making the cedi to strengthen against the dollar, as we've seen in our tests, we are going to see a sustained, if you are able to see a sustained and a long-term stability of the cedi against its trading peers, we may start to see some of these impact. I think this will bring us to the end of our presentation for today. Would like to hear from you as well and see what your thoughts are on the discussion today. Thank you very much for listening.
Absolutely. Thank you very much, Sunkari. The floor is open now for any questions, contributions, or submissions with respect to this particular presentation. I also mentioned that we were going to have a brief anonymous poll. So whilst people are putting their thoughts together to ask their questions or submissions, okay, we have a hand up. So now your mic has been allowed, so you can go ahead and ask your questions or throw in your suggestions and submissions.
All right, great. Thank you so much. Thank you, Black Star, for taking time to do this research. It's been very informative, and I want to say thank you. So I just wanted to ask the presenter in 2 minutes, if you can kindly summarize the reasons why the cedi has been performing better or has been strengthening against most of the other trading currencies. I would really appreciate it in just 2 minutes, just a summary of the reasons you gave. Thank you.
Okay, thank you for your question. So as I said earlier, if we look at it, it depends on which part of history you look at the variables. So if you look at it for the past 5 years, all the things we are saying is actually strengthening the cedi seems not to be true. If you look at it the last 3 years, we started to see maybe a structural shift. We saw a reduction in those correlations, which also means that it may be starting to kind of help the cedi strengthen. That is, the gold prices going up, the export, the reserves building, the Bank of Ghana reserves building, the aggressive domestic gold purchase program. But when you look at all of these, just within the last few months, that's just last 1 year, the last 1 year, we found out that it could be the fact that we are building our reserves because if we look at, as I showed earlier, there is kind of an aggressive buildup of our reserves that is happening. And our reserves have always been evident enough that is help strengthen our cedi. And we are actually, the reserves building is within here. And it's more evident that it's actually helping the cedi. So if you just consider just last year, just 1 year ago, we think that it's actually the aggressive building of our reserves that is kind of strengthening the cedi, because it actually makes sure that there's enough FX reserves to meet the demand on the market. We also benefit benefited from the high gold prices. As I said, if you look at it for a longer period, we were not actually benefiting from that. But if you look at it just 1 year ago, realize that the high gold prices, which essentially means that we locked in on higher prices, who translated just directly into our reserves, which is now boosting our FX supply. So if you look at it, it just depends on how far you go back in history to look at it. So by just within 1 year ago, but 1 year is so short-sighted. That's the caveat there. 1 year is short-sighted to make any serious argument. But just within 1 year, with that, because there is aggressive liquidity mop-up the few months of this year on the domestic market, which is making the cedi scarce on the local market. Gold prices also rising, which we locked in. We were able to capitalize on that, lock in on the higher prices, which boosted our reserves, as we've seen in how our reserves have rallied just 1 year ago. It's up almost 50%, which have lifted the cedi. That's just 1 year, but then 1 year is short-sighted. I don't know if this answers your question.
It does. It does. I'm grateful. Thank you very much. Thank you.
Thank you.
Okay, Enoch.
Yes, thank you very much, Blackstar. I think this is a very exhaustive presentation. I just wanted clarity on the gold for oil purchase program that was initially instituted. I've seen from your presentation the impact it has had on our currency. But then just about 2 months ago, we saw that the BOG has suspended its gold for oil purchase program. I just want to know from your perspective, does this suspension sort of undermine the gains that the city has made in the long run? That's looking ahead into the future. Do you believe that the purpose of the gold for oil suspension would sort of reduce the impacts of the gold board in a sense? I don't know if I've been able to explain my question clearly.
Yes, I think I get you. So if you look at the gold, as I said earlier, the time we had a gold for oil program, a lot of our pressure points, as I mentioned earlier, were not coming to play. Because the time we had the gold for oil, you realize that we paused maturities payment, which meant that a large demand that would have been exerted on the dollar would have weakened the cedi, which was not done. We paused payment in those same level. So if you look at the gold for oil, it happened at a particular point that a lot of other factors were in play. A lot of pressure points were not really activated on those periods, which will mean that it's not entirely the gold for oil program that pushed that caused the cedi to strengthen against the dollar. But then again, I just feel like I don't think the gold for oil program suspension is going to have a significant impact, because it's kind of like a zero-sum game that is being played here. We are no longer exporting our gold. We are no longer exchanging our gold for oil. We are now aggressively building our reserves. So what it means is that what we would have used to directly exchange for gold is now passes through the right channels, which will end up in our reserves building. And we've seen earlier that our reserves building actually lift our cedi. So I think that it's kind of like a zero-sum game that is being played here. Lifting it will not really have any significant impact. Even looking at it, that we can't really assess the individual impact gold for oil happened pause on our cedi, because at that time our major pressure point, which is debt, Eurobond payments, were suspended.
Right. Thank you very much. I think that clarifies the goal for oil purchase. I think my final question would be on the fact that I understand the city has been appreciating, and you've made it clear that our reserves is a major contributing factor to this appreciation. I just want to understand, is that the only reason, or my understanding has been that the high imports, that's the difference between our imports and exports cover also sort of improves the gains the city makes periodically. Beyond that, to the remittances that we receive from outside, that's the inflows we receive from foreign investors, also pushes the gains on the city. Beyond that, we see that Trump's policies so far has been targeted as destabilizing global trades. And we see that there's this import bill which is aimed at sort of reduce taxing remittance outflows from the US economy. Do you believe that those taxes and those policies would also have an impact on the performance of our currency?
Okay, so if we look at our import bill and our trade balance as far back as 2017, we've seen that we've been running a positive trade balance, which means that more we import less than we export. So if we look at our correlation analysis we did and our regression, you realize that it just also depends on the part of history you look at. Because when you look at the past 5 years, even though we've been running a trade balance, the import was not really having so much negative impact on the city. It's just when we get to the last 1 year, we saw that maybe it may be having a link, it may be helping the city. And then also to the remittance issue, these are just announcements, right? There's no actually available data that is showing how the impact of the taxes is going to be. We can't actually assess the magnitude to which it can be on our remittance inflow on the market. But what taxes are not really. Taxes cost us, right? It's an indirect, it's a cost on us, right? So maybe you may not see enough inflows, but that may not be that significant to cost us a lot in our FX market.
All right, thank you very much. I think that clarifies everything for me.
All right, thank you very much, Enoch. Edward, you can come in with your question. Yes, Edward.
Okay, all right. Thank you very much. I just wanted to find out, as an advisor, whether you have any alternative strategies that you think policymakers can also adapt in sustaining these gains. Because you realize that from the presentation, it appears that the gains we are seeing are largely on the back of our reserves, i.e., the increase in gold price and all that. And we know these dynamics won't stay the same. So in the event that gold prices begin to tumble and maybe the dollar begins to gain strength globally, do we think the strategy we are adopting can help sustain the city? Or if you can suggest any other alternative strategies the government can adopt, I think that will help.
Okay. I can't suggest to BOG, but I can actually give my view on that. So the BOG recently, the Deputy Governor, Dr. Zakari Mumuni, actually mentioned that they are actually treating the reserves as if it's a portfolio. They are actively managing it. So as and when one asset class is favorable to lock in to capitalize on, they do that. And then as and when it is not favorable, they look at other strategies if you look at our reserves, as I said earlier, the composition is gold. We have gold there. We have foreign currency denominated assets in there. We have the US treasuries also in there. So maybe if they still keep to build the reserves to a certain level and actively manage it, as they said earlier, maybe we may be able to capitalize on other sources rather than the gold prices, relying on gold prices rally.
Okay, thank you very much.
All right, thank you, Edward, for your question. Lula, you had your hand up. Are you okay? Has your question been answered?
I was just curious about so I do know that the Ghana Gold Coin initiative was just to help mop up excess cash in the system. But if the gold coin is indexed to the US dollar, wouldn't the appreciation of the cedi make it less attractive to local investors and essentially counterintuitive for encouraging domestic patronage?
Lula, could you please come again with your question?
Okay, I was asking if the Ghana Gold coin is indexed to the dollar, right? And now we see that the cedi is appreciating against the dollar. Doesn't it make it less attractive for local investors? Because like it's now counterintuitive for people now to use their cedi to buy the gold coin because the value is depreciating.
Okay, I think what this basically means is that your cedi, as I said earlier on, you may require fewer cedis to actually do the purchase now. So net, for you, if you're a local investor in Ghana and then you have cedis, it becomes cheaper for you now. But for foreign investor, as I said, the consequences of having a very strong dollar is you will lose competitiveness. So it may become expensive for a foreign investor, but become actually cheaper for local investors. And it was actually made for local investors, by the way. It was a strategy to make sure that local investors have a way of getting access to the total gold we are blessed as a country. I don't know if this answers your question.
Yes, I'm good for now.
All right, Lula, thank you. If anybody has question that they want to put it in the chat box, we can also read it from there. While at it, I would like us to conduct a brief poll, just 7 questions, and then we come back to our questioning and answering. Please stay on and answer the poll questions for us. They are very anonymous and nobody would know who chose what. Okay, so the first set of questions is actually on inflation. Yeah, just 3 questions in here. I'm just about launching them. So first of all, we would like to know from you where you expect Ghana's inflation to trend over the next quarter, given April's 21.2 print. Do you see it as declining further or remaining volatile or rise moderately or stay broadly stable? In that same set, so we would like to know from you what you make of December's inflation prediction. The government has set a target of 11.9%. The monetary, which is Bank of Ghana, has also set an end of year target of 12%. We would like to know what you think. And then also, what do you believe is currently the main driver of inflation in Ghana? Is it currency appreciation, or global commodity price movements, monetary measures by BOG, measured fiscal spending, or global commodity price movements? Okay, and so this particular presentation, what did you perceive to be the main underlying variable for the cedi's appreciation? Was it external factors, i.e. the general weakening of the dollar and tariffs, or gold reserves, export inflows, monetary policy measures, low dollar demand, or fiscal-based consolidation? We know most of these variables have played a role, but we want to know from you what you thought was the main underlying variable. Also, do you anticipate the appreciation of the cedi to be sustained? And where do you expect the cedi to finish the year at? Would it be below 8, between 8 to 9.99, 10 to 11.99, or probably above 18? Let us know what you think. And then finally, from tomorrow, the MPC would start their meeting. And by 26th, we would know the new monetary policy rate. What do you perceive or expect to be the outcome of their 124th meeting? Are you predicting a further tightening or monetary loosening, or would it remain the same, or you are uncertain about it? Okay, now we can come back to our questions. So I have a few questions here that has been sent to me. So the first one wants to know, stability is what the business community seeks for planning. And the Bank of Ghana will tell you, unlike inflation, they don't do exchange rate targeting. But at what levels do you think we should expect some form of stability? 8, 10? At what level?
Okay. This question is really like playing the devil's joke, but I think I'll go ahead. So if we look at other people that have done research on the same topic, for instance, Absa Bank have done a research on the recent research of the cedi, and they are of the view that currency is going to trade between around 14 by year end. And Bloomberg also have their forecast for currency, and they're also expecting currency to be around the 13 band by the end of the year. And I just don't feel like there is an actual number that a currency will need to get to and just pause. What we should be looking at a band to which it trades at. So if you're able, right now we are down to 12, almost 12.3 pesos for a dollar. If we are able to keep it there for a very long time, I think that is going to be fair enough. If we are not able to keep it there and it still goes down, I just don't feel like there is a point. There's just there's certain like a point that we need to get to start saying, or maybe we start celebrating or something. I mean, we are still not one for one. So yeah, I just feel like even if it's going down, but there's not really a point we need to be targeting that we should not keep it so low. I mean, that as I said earlier, there are dangers of keeping it so low. But if it goes low, I don't think we're going to be hurt so much, since it's not still, we'll never get to 1 for 1 anymore anytime soon. So anything above that, I feel like it's fine, but it's there are implications, but I think it's really fine for us in the domestic market.
All right, thank you, Sunkari. Kafui, you wanted to appreciate some clarification regarding the points on the gold reserves accounting to 2.7 billion. Kindly confirm whether you were referring to an export of 30.5 tons or an accumulation of 30.5 tons.
Okay, so if we look at this year, our gold exports is half. Sorry, With export, if we look at our gold export, we've exported as much as we've accumulated in our reserves over the same period, right? So if you look at our gold exports this year, we exported almost 30.5 tons, which is equivalent to 2.7 billion. And if we look at our reserves, we also accumulated almost 31, so almost 31 tons, just 1 point something tons difference. So if you look at it, actually, we've exported as much as we've accumulated over the years.
So that is to say, if we had not exported any gold, we would have had about 61 tons of gold reserves.
No, I don't think so. What it goes into the reserves is different from what goes out as exports.
All right, thank you. Any other questions or contributions? We should be wrapping up now. All right, thank you very much to our presenter, Enoch Sunkari. At least now, assisted by the data, we can confidently contribute to the discussion to say that the Cedi's recent rally is not merely a product of external lack, i.e. the general weakening of the Cedi, but also the result of some deliberate efforts and favorable, you can say, internal trends from both the fiscal and monetary space. And that's very enlightening. Thank you very much for your regression results as well, to let us know what the impact of each contributing factor has been. Thank you to our audience for staying engaged throughout the session. Market Color comes off every third Tuesday of the month. We usually discuss market updates and then also any trending topic, any hot topic within the financial landscape. We decide to throw more light on it. So as we wrap up, I encourage you also to explore our wide range of investment solutions available here at Blackstar. I mean, our global markets desk, our asset management solutions, and then also we have an IB desk. Domestically, we are into FI trading of T-bills or the new bonds, corporate bonds, and we also have a vibrant equity markets desk. We are also a PD and a BMS. We were able to retain our mandates, and so you can actually tender your auction bets through us. We also have a very active FX desk, which you can do your FX transactions through. Internationally, we have managed to establish a relationship with over 25 exchanges across the world to allow you to take opportunities in external equities and then also equity-like instruments. This morning, for example, I saw a report showing European ETFs doing in excess of 25% year-to-date returns. And I mean Poland, Austria, Greece, Spain, Italy, Germany, and even Finland. So we can turn our attention there. When it comes to fixed income too, we are able to execute US Treasury bills, notes, and bonds, the UK gilts, Euro bonds issued by African, Asian, South American, and even some European economies as well. And also corporate debt instruments issued by blue chip companies. We're able to execute all of them. In-house, we also have mutual funds that have dollar exposure or exposure to global assets. Our enhanced equity beta fund, our Christian community mutual fund, and then Delta funds are all funds that you can take advantage of. So yeah, if you are keen on diversifying outside of Ghana for a broader opportunity set, and maybe you are like Warren Buffett who buys quality companies at discounts, then we have a bouquet of offers to assist you do that. This goes to the banks as well. So maybe this could present a good avenue to expose your private clients to some of these global assets. On our IB side too, we are into M&A advisory, equity and debt capital, valuation, structured finance, among others. So you can always reach out to us. I saw a post from somebody who was requesting for the link to this particular presentation. Of course, we are going to share the recorded version on our YouTube page. So you can visit us on YouTube at Blackstar Group. Also, we tend to put some of these analytical results on our social media pages. So you can just follow us on all our social media channels at BSG or Blackstar Group for some of these things. Once again, thank you for joining us. We look forward to engaging with you in our future sessions. Like I mentioned, every third Tuesday of the month. Stay informed, stay invested. Have a very great day. Bye bye.